Hello everyone, I'm Shubham Jain and welcome to Expert Take powered by Yubi, world's first possibility platform. Today we are getting Mr. Arnab Basu's expert take on the role of NBFCs in funding infrastructure projects. Mr. Basu, who is Chief Operating Officer for Project and Structured Finance at Aditya Birla Finance Ltd, he has been instrumental in building the infrastructure and project finance business with a current book of around Rs 11,000 crores. Welcome, Mr. Basu. You have been a veteran and a lender who has looked at infrastructure sector very closely from decades now. And a lot of things have happened in the infrastructure sector, if we say over the last 7-8 years. There have been a lot of policy initiatives, policy interventions. We see exit of very large players because of the last cycle. We have seen entry of large PE players also. So if I have to ask you, how do you see the last 6-7 years in infrastructure sector, if you can summarize it for us and the viewers?
Yeah, Shubham, like you correctly said that, we've seen this sector for over a decade now. And yes, I think the early part of the decade, 2008, 9, 10, 11, there were challenges. There were challenges with regard to project implementation. There were challenges with regard to linkages and stuff like that. But over the years, we've seen that, things have really streamlined and come out very well. In fact, if we look at our project financing portfolio, which is matured to the extent of maybe 10 years plus now, I would think that it's one of the best portfolios which we have in terms of quality, in terms of delinquency, and in terms of performance. And in fact, to be also very candid about the current situation, while the project finance exposures typically are expected to be long dated, maybe 10 years, 15 years on paper, actually they've been refinanced very fast. So, that shows the potency and the strength of these exposures, that, they've been refinanced quickly by banks at much lower rates. So that way we've seen the sectors, specifically if you look at renewables, roads, and now logistics is picking up as a sector.
Sure.
It's doing phenomenally well. I think we've come a long way with regard to the status of project finance and specifically in the infra sectors in the last few years.
Sure.
And most of the lenders like us have been enjoying a very good standard and healthy portfolio.
So if I have to ask you, sir, maybe to name 3-4 factors which have resulted in this, have the lenders become more mature, or sponsors have become more rational, or it's the government possibly intervention? So how would you say that, okay, from 2008-9, what we faced to today, where we are? So what has changed in there?
I think, Shubham, it's a blend of all the points which you mentioned. It's been government policy initiatives where, approvals for projects and specifically environmental and other approvals have been streamlined and has come much faster and in a much better and concise way. It has been the sponsors who also have had the experience and the learnings, which has been resulting in satisfactory implementation of projects. And it's been the lenders who also have, acquired this expertise and experience. To put it in perspective, lenders' disbursements, usually, as a lender, when we do a disbursement, we usually ensure that most of the approvals are in place and maybe 80-90% of the land has been in the control of the sponsor, which were the significant challenges which used to delay projects earlier. So things like this, I think it's been a learning process for all of us, which have improved the pipeline of implementation.
And rightly said, sir, I think lenders have gained a lot of maturity, because if we look at last 2-3 years when the liquidity was huge, even
Absolutely.
then at that time we have not seen irrational lending.
No.
Or very aggressive lending.
I agree. Only thing, one point which I would like to make is that, while lending has not been exuberant or irrational, pricing has been very fine. I think the slosh of liquidity has allowed for very fine pricing, which is where, there's been a significant amount of refinancing, not only for our portfolio, but also for others as well, where banks and a few other institutions have refinanced good, healthy project finance portfolios at very fine rates.
Correct. Also, sir, one other, I think, pertinent observation of the last decade is that Indian infrastructure sector, especially the operational, has been able to attract a lot of large private equity funds like Brookfield, Macquarie, Blackstone, or Cube, issuances, etc., which has not only brought the capital, but also has brought the discipline in the system. So how would you look at it?
No, it's been a fantastic development which has happened in the sector over the last few years. For one, it has allowed the developer to move out of the assets, which necessarily is not their business.
Correct.
If you look at from the perspective of a developer, after he develops the project, he would like to move on to another development, because you see, the churning should happen, and that's where his skill set and his ability to conduct business is. Whereas there should be a different set of investors who should continue with the long-term operations of these assets and enjoy the annuity-like returns, which is where investors like Brookfield, like Macquarie, like GIP, General Infrastructure Partners, they have come in and they've provided this patient long-term capital.
Correct.
In India, if you see our homegrown NIF and a few other investors, they also have got into the financing of operational projects.
Correct.
And many of them have also developed in-house expertise to build platforms.
Right.
If you look at an Actis, if you look at an even Brookfield, I mean, or a Cube Highways, they've developed core competence of managing, developing, and running platforms for roads, for running renewables. And some also have developed platforms for running logistics.
Correct.
So that way, the sector has definitely gained a lot by way of governance, by way of knowledge, input, and expertise.
And also the best practices, I think.
And the best practices also have come across the sector right now.
In fact, I remember one of the large PE players telling me something about this, how they maintain the road.
Absolutely.
Micro-maintenance, etc. And save a lot of costs. So I think it's been really a boon for the Indian
In fact, just another point to add here, when you're talking about the global expertise, use of drones to look at the roads, to maintain. I mean, we've been doing it as a lender. It's been one of the interesting, practices which we've inculcated and which is really standing out in good stead. That, instead of physically going and doing inspection, etc., drone can cover the inspection of the road in a much better and more efficient way and give you a report which is very precise and concise.
Correct. So again, but the other point is that even as a lender, there's a lot of appetite for operational, stabilized projects, right? Which generally remains the area of interest for these PE players also. So what different government can do to attract their interest in Greenfield also?
You see, I would break up the question into two parts. First is, as a lender, we are open to looking at Greenfield as well as Brownfield projects. Now, we assess the risks, we price it accordingly, we put suitable covenants to ensure that the disbursements happen on a milestone basis based on the physical progress of the project and the accordance of the approvals. So that way, we are not, as a lender, we are not averse to looking at Greenfield or Brownfield projects. From the perspective of a PE investor, I think the initial outlay which they had focused on was operational projects, and rightfully so, because if you see in the early part of the decade, maybe 2010-11, many of these PE investors had burned their fingers.
Exactly.
They had taken minority stakes, they had funded large groups for under implementation projects, and there the experience had not been that satisfactory. So I think when they came in again in the mid 2015-16, that range, they consciously took a decision to look at operational projects, and where they took not minority but majority stakes. So they started managing these projects. They took over roads, they took over renewable projects and started managing it.
Correct.
And then after they developed this expertise, now they're moving into platforms where they're creating and originating projects.
Yes.
So I think it's been a good life cycle which has happened over the last few years, where the learnings, the value additions and the governance have improved the entire sector in perspective.
And sir, in the same line, in fact, InvITs has been a very good instrument or a good platform which is providing an exit to the sponsors for their operational projects. And I think government's intervention has been quite significant in a positive manner, which has created a very, very good, strong pipeline. But one thing to be noticed, that still majority of issuances are privately listed. We just have 3 or 4 publicly listed InvITs. So any thoughts on that, why still we are not seeing
I think InvIT as a product initially, I don't think the Indian public was too aware or educated about. So it's neither debt nor equity. So they did not know what kind of a product it was. perhaps which is why I think, it did not really gel well with them initially. But I think going forward, if you see last few InvITs, a number of them have been public InvITs and have been oversubscribed by the public. But on the other hand, the sovereign funds, the pension funds, the wealth funds, they are very keen to look at these InvITs because they manage patient capital, which requires long-term annuity returns. So I think from the developer point of view, what I understand after speaking to a few developers is they would prefer a private InvIT because it's much easier to manage. Two is that, in case of certain private InvITs which are not listed, your leverage can be slightly higher. So all taken together, it's easier for them to manage, and the accessibility of investors for private InvITs is fairly large. You have a ADIA, you have a Ontario OMERS, you have a Hong Kong Monetary Authority, you have a plethora of investors who have patient capital to deploy. So I think it would be a mix and match of both. I mean, there would be public InvITs like what Embassy did recently, what Power Grid did, what Sterlite did, which has been now funded by KKR. And you also have private InvITs.
It will be a mix.
It will be a mix of both, I think.
Any areas of improvement in InvITs which you still think has not been tackled, some open points as a lender which you feel?
I think we are going the right way. Perhaps on the taxation front, what I understand is that, if they are taxed is in a manner similar to equity, that, after 1 year, if they have a capital gains, long-term capital gains, that perhaps would attract even more public investors.
Sure. Now, coming on specifically on the NBFCs, where again, you play a very, very large and significant role for the infrastructure sector in the country. Now, RBI is increasingly, again, in terms of regulations, RBI's intervention is increasing. The overall flexibility, which again was kind of an edge which NBFCs had over the banks in terms of structuring, maybe funding some structures, funding some kind of maybe situations where banks' hands were tied, etc. So how do you see the medium term playing out for NBFCs?
See, I think the Indian financial sector changed radically after 2018, post the ILFS outbreak which happened. And post that, I think, the regulator has been fairly active in trying to manage the systemic risks.
Correct.
And like Shubham, you correctly mentioned that, there are, apart from banks, number of NBFCs, including ours, who become systemically very important and very big. They pose a fairly large threat with regard to the financial sector by virtue of their size, their scale, etc., which is why the regulator RBI also has gone towards scale-based approach with regard to NBFCs. Now, having said that, I think, the direction has been right, and NBFCs like us have already aligned ourselves with regard to the stringent regulations which has been imposed in banks. And the ultimate objective, I think, is to align the regulations between the banks and the NBFCs. But having said that, you see, the inherent advantage of an NBFC in terms of the flexibility of end use, I think should continue and is still continuing.
Okay.
For example, an NBFC can fund a M&A activity. NBFC can fund a equity or equity-like end use. NBFC can fund a takeout of a PE, which perhaps may not be really bankable end users. So I think that situation of a fairly strict regulatory regime in terms of the structure, the management and the running of the NBFC, coupled with the flexibility of end use, is a good situation for the NBFCs in India.
And this is very much required also, because if we also look at cost of funding for a bank vis-a-vis NBFC, like banks have the advantage of CASA deposits, which is very, very competitive, right? And NBFCs will never get access to that.
Which is where the advantage of an NBFC by way of looking at the structured opportunities, which is the equity like or the mezzanine opportunities, which are not really the bankable end uses, which opportunities with regard to M&As, mergers and acquisitions, etc., provide them with a slight yield pickup, which is what broadly balances out in terms of returns and expectations.
And so, like, just continuing the same point, the competition in the sector is also increasing, especially if we look at HAM sector, right?
Yes.
Right.
Yes.
Biddings have been very, very aggressive.
Absolutely.
Like
Yes.
at a discount.
Yes.
At one point, someone was bidding negative O&M.
Yes.
So yes, there have been instances. So for such projects where the IRR is really very, very competitive, to come to an NBFC and get a funding at maybe 10-12%. So how do you see the maths working there?
See, I think for HAM projects, 10-12% is a myth. It's not possible. People are funding them at 7 and 8, maybe much lower single
in the
digits.
construction state, sir, I'm saying.
Even in the construction state. Even in the construction state for good developers. NBFCs have played some kind of a role predominantly by way of their expertise. You see, this funding of infrastructure projects requires a significant amount of expertise and focus, which certain NBFCs have, including ours, have developed.
Yes.
And two is that, like I said, that along with the low yielding products, NBFCs also do a few of the high yielding products. And secondly, we also, as an NBFC, do the syndication and underwriting model, whereby we underwrite the entire transaction and downsell a part of the risk to the banking system, which allows us to bump up our returns. So a combination of a variety of these inputs allow us to maintain the expected returns and profitability.
And other related point again on the ALM, asset liability, because banks definitely have that advantage of having very long-term liabilities, and that also enables them to have long-term exposures.
Yes.
Whereas possibly mutual funds or NBFCs may not have that similar kind of maturity of their liabilities. So do you see that as an inherent disadvantage, or there are ways to mitigate that?
See, as an NBFC which is having a diversified book, we are having different kinds of businesses. So, we are having businesses in the shorter end, which is supply chain financing, which could be less than 1 year. We are having businesses which are in the range of corporate funding, etc., which could be in the range of 1 to 3 years. And we are also doing infrastructure and project funding, which could be more than 5 years. So, a blend of all, I think, takes care of the ALM reasonably satisfactorily. The second is that in certain cases, we usually negotiate put calls after maybe 3 years, 5 years, etc., etc. That provides us with the wherewithal of accounting that for AML purposes for a 3-year or a 4-year exposure, because we have the ability to exit the exposure at that point in time.
Okay. And strategically also, I think it may be better for you as well as the borrower that it gets churned after
Absolutely. Because like I said, that ultimately, while on paper, project loan is long dated, maybe 10 years, 15 years, sometimes 17 years. Actually, on an actuarial basis, our average book is around maybe 2.7 to 3 years. Because it gets churned, it gets refinanced by another set of lenders or a set of investors, or maybe by way of bonds.
And that's such a beautiful combination, like as you said, that NBFCs have developed that expertise, sectoral expertise, to underwrite the project during the difficult stage.
Yes.
Right.
When they understand the project better.
When they understand the project, they can put in the mitigants so that it doesn't go haywire. Right. And once it is stable, then it is rolled over to a money market or a bank. That's such a good thing. But at the same time, sir, the participation from other long-term investors like pension funds or insurance companies has remained very limited in the infrastructure sector. So any reasons or any things which can...
I think overseas funds, like we discussed earlier, have come in significantly.
But in India, I think...
In India, I think the market is yet to mature. And the other reason which I see is that, like again, the liquidity where it was over the last couple of years, I think the banks themselves had provided a solution. To fund the operational projects. So, I mean, you need not have gone anywhere else because of the availability of liquidity amongst the banks.
Sure. And like we talked about good initiatives earlier, the first point that we discussed, that a lot of good has happened. At the same time, there were various initiatives which have not taken off as it was envisaged, like IDFs or maybe IFCL, credit enhancement scheme, etc., etc. Any reasons which you think what led to not so successful?
See, IDFs, I mean, if you look at the two operating IDFs which are there, their book is close to about 30,000 crores, which is not small.
Which is not small.
Not small. But having said that, IDFs have a couple of inherent disadvantages, so to say, structural disadvantages. One is that, if you have to float an IDF, you have to be either a bank or you have to be an IFC with a 3-year track record.
Yeah.
So that limits the parentage to float an IDF. And secondly, I think, IDFs require this project authority guarantee and the termination rights, which may not be too acceptable amongst the consortium of banks who are not getting that access. So maybe because of these structural issues, maybe they could have done a little better than what they have done so far. But of the two IDFs, as I mentioned, I mean, a book of 30,000 crores between the two is reasonable.
Anything on the partial guarantee scheme, sir?
Partial guarantee schemes, yes, again, has not taken off too well. Again, I think, my understanding, and after discussing with IFCL, who has provided this partial guarantee to start with, the feeling is that for good projects which are operational, the banks themselves have provided solutions.
Yes.
So I think going forward, as the infrastructure sector evolves and the more number of projects come in and in different sectors, I think it should be an opportunity which could be looked at.
On the DFIs, like again, there had been a lot of initiatives earlier, maybe starting from ICICI, IDFC, IFCI. We have so many, right? And again, possibly somewhere they have not really charted out what initially was thought about. Now, government is very, very focused on the new DFI, NABFID, and they have also funded. And what we understand is like within this year, they intend to possibly build a book of 20,000 crores. So are you seeing some differences in the way the things are being done this time? And we can really be very hopeful?
I think, it's a question of evolution. When ICICI, IDBI, IFCI had evolved, that point in time, there was a requirement for these institutions.
Correct.
And they served their purpose. Then, of course, going forward, they became so big that, they had to transform themselves into banks to provide the liquidity, the liability solutions. Going forward, again, I think because of the huge pull on infrastructure, which is definitely going to be required to push up the GDP at the expected levels, there would be a requirement of a development financial institution, which the government has already planned out and I think is in the process of being rolled out. Institutions like us, like Tata, like Asim now, new institution which is there, they've also served their purpose in terms of, supporting the infrastructure sectors, the project finance sectors, etc., etc. So I think it's going to be a mix and match, and the requirement going forward expectedly is going to be so huge that, there would be a requirement for everybody.
Earlier we spoke about InvITs, publicly listed InvITs and privately listed InvITs, where you mentioned possibly the retail investor today is not aware enough about this is a debt or equity. So that is one point where as Yubi, we have taken this charter and responsibility of channelizing huge retail saving, which is sitting possibly in fixed deposit of around 150 trillion and increasing at the pace of 12-14 trillion every year, to provide retail investors good fixed income options. So what is your take on that, sir? Are the investors ready or mature enough to understand the nuances of sectors like infrastructure, real estate or manufacturing, where they can participate in fixed income? Or any other thoughts you may have on this subject?
No, I think the investors are reasonably getting educated in the process, because if you see the latest investments into the public REITs and InvITs, there have been a fair amount of retail participation. And I think, platforms like Yubi, where you bring the lenders and borrowers together, will play a very, very significant role in terms of packaging of these instruments, making the investors aware of the products, rate them, list them, and provide them as a bunched up offering for their investments. So I think there's a huge opportunity in the market, and most of the investors, including myself, we are looking for fixed income returns with decent yields, which was just not available in the market.
Thanks a lot, Mr. Basu. It was really a pleasure talking to you and getting to know your views on this very dynamic and growing sector. Thanks a lot again for participating and giving me.
I thank you, Shubham, and I thank Yubi for giving me the opportunity. Look forward to having a tete-a-tete again sometime.
Thank you.
Thank you.
Thank you for joining us today. Stay tuned for more such interviews with experts who are transforming the debt industry through technology to fuel India's growth story. Thank you once again.